Good morning. Let us start our review, as always, with the shorter end of the US curve, which is the 2-year note. Last week, the 2-year note broke through the lower end of the band and basically traded around, having discounted most of a rate hike in June or July. This is the price action on Friday when Chairman Yellen gave us basically a confirmation that the June and July meetings would be live. All it's done is gone to the lower band of support, which is right here at around 108.31. It's tough to see it going much lower. On the other hand, rallies are definitely a sell. The same yield curve flattening continues, as can be seen in the 5-year note, which is coming up to very good support around this area here, which is 120.04. This is certainly an area where you do not want to have positions, short positions. You want to be flat when it touches that line, and then you want to be a seller of rallies back up to this kind of level, 120.19, 120.17. And the yield curve, as we said, keeps on flattening. You can see what the 10-year note is doing. It is coming up to 200-day moving average support. This is on the dailies, which is still sloping upwards, and these Bollinger Band levels around the 129.06 area, 129.02 area, where you definitely do risk reward says do not be short. If it touches 129, you definitely do not want to be short anymore, but you want to be looking for opportunities to get long for a bounce back up towards the 129.5 to 130 level. The yield curve keeps on getting flatter. There is not much doubt about that. 30-year note proves it even more. It is all it has done is gone back towards the middle of its trading range. This is the bearish trading range. This is the neutral trading range. It is just not breaking down with any conviction. So that's all that can be said for it. Yield curve flatteners are still profitable, and therefore there is no reason to doubt that that situation would change in the shorter time frame. The European markets are doing nothing. They're very well supported. The Schatz is still in a pretty bullish configuration, even though it's yielding negative 40 basis points. There is no pressure at all for higher rates in Europe, as can be seen from the Schatz, which is trading in this area where it's been trading for weeks and weeks. Nothing to be said for it. The bubble, if anything, is looking slightly more bullish. It is threatening to try and take out these higher levels, but at the moment it's not doing it, and the Bund is very balanced. There is no selling pressure in it. The buying pressure does get exhausted when we get towards the 164.60 area, but it's very well supported around the 163.25 area. This is the area that we need to see busted to have any kind of downside movement. So 163.25 is your swing level. If it busts through 163.25, there will be some movement down towards the 161 area. But at the moment, Europe just shows absolutely no higher rates pressure, no reflation pressure whatsoever. The interesting charts of the equities, you can see this is a 5-minute chart. You can see just how well supported, sorry, a 10-minute chart, you can just see how well supported the market is. Every time it dips towards this moving average, it's bought, it's bought, it's bought. There is no fear whatsoever, there is no selling pressure whatsoever. On the dailies, we are at the top end of the Bollinger Bands, and we are above all moving averages. The 200-day moving average is now flattening. The 100-day moving average is moving higher to potentially cross with the 200-day moving average. The RSIs are not hugely overbought. Volume is completely static and low. What is going on? Well, our read is quite simple. The market needs to digest the next potential move, which we still think is going to be higher. But at the moment, there is no impetus for that move. We have a situation where the Fed is threatening higher rates, where the market is discounting it. We have a situation where earnings are not growing, or certainly are not going to be as powerful in their growth trajectory as they were 2 or 3 years ago. So that means that they're not getting worse, but they're not getting better. And the market is just reacting to liquidity flows. There is a lot of cash on the sidelines, and that probably can be best seen in the Russell, which is the less blue chip component of the market. It is in a more bullish configuration than ES. That means that all the spreads are coming in. People are reaching for any kind of yield they can get. They're reaching for yield in the 10-year note, they're reaching for yield in the 30-year note, they're reaching for yield in equities. That is what is going on. They're reaching for yield, but the earnings don't justify much higher prices. So liquidity is just basically pushing prices higher, even though there is no particular reason for higher prices. It's just liquidity driven. The Europeans again are reacting to the US driver. The DAX and the stocks are in a bullish configuration, but they're getting very, very tired. This is a market which any kind of bad news is going to knock down 2, 3, 4% in a hurry. Why? Because the latest buyers at these levels are not strong hands. These are people who have reached for yield but are fearful of they're doing it against their will. They're absolutely not strong hands, but on the other hand, this trend could continue for quite some time yet. The same can be seen in stocks. Absolutely the same kind of configuration. The market is getting tired. It had one push up, and now it's just being liquidity driven. All money is being absorbed by the market with higher prices, and these people, if any bad news comes out, will be left high and dry, and the market will be trading down at these lows again. We're talking about the 2,800, 2,700 area very, very quickly, and then it'll continue to bounce. We think that this is going to go sideways for quite some time, and therefore these are markets that you want to avoid the longer term plays in, but what you do want to do is trade them intraday with tight stops. That is all that can be said. These are going to be very technical markets that when they break certain moving averages in different time frames will react violently. So if the market breaks this uptrend line here, it'll very violently move down to the bottom of the Bollinger Bands. It's just what these markets will do, simply because the conviction of the players is very, very low. Now, the VIX keeps on trading lower because there is no fear in this market. There is no fear of much lower prices, and the the flows into the markets are all positive, which tends to drive the VIX down. Do we exclude the possibility of testing 1150 in the VIX? Absolutely not. We think that the market will continue to trade lower with spikes when bad news happens. This is absolutely not a positioning market. These are trading markets that you want to trade purely on technical basis. The major foreign exchange markets basically confirm the opposing trends of the US and European fixed income markets. You have a flattening yield curve with 2-year notes yielding ever higher levels as the Fed tightens, while you have a very well bid fixed income market in Europe, which basically means that the spreads between the US and Europe are constantly going out. The yield differential is constantly higher, and you have a market which has backed off as a result, and after some backing and filling could continue lower towards even the 107 and possibly the 105 area over the next few weeks and months. You can see how the stochastics are absolutely stuck on the downside. There is no, every bounce keeps on getting sold. Every bounce keeps on getting sold. So unless and until this picture changes, there is nothing to be done but keep on buying the dollar on dips. And this can be seen in the dollar index, which is trading technically very nicely. It comes back to the lower Bollinger Bands and to the bottom of the and to its moving averages, and then bounces. This will be a continuing picture. It'll be a technical market which all support needs to be bought. So buy support, sell resistance, and keep wash, rinse, and repeat. That's our game plan, and this is just not a time to be buying gold, because the dollar keeps on getting stronger and stronger and stronger. Daily gold picture. Until we test the 1160 area where the 200-day moving average is, and it'll probably take quite a bit of time. This is not about a buying market. You can see how many red candles in a row we have here. This is a market where people are liquidating their long positions day in and day out. They're basically liquidating because there is no point in being long of gold at the moment. The dollar is going up, equities are rising, fixed income offers attractive yields. Therefore, the alternative, which is the precious metals, is not something that people want to hold for very long. And until this picture changes, you won't see much selling in equities at all. Oil is supported. It's still around the $50 area. Every technical, I mean, this picture looks very, very bullish. Every time the market comes down to support, it gets bought, and it goes back up to resistance, and it comes back down to support, etc., etc. It's just like the dollar index. The dollar is trending upwards, the oil is trending upwards, equities are trending upwards. There is absolutely no reason to sell any of these markets. All this really is confirmed and encapsulated in the Blue Angels published by Yardeni. As you can see here, and actually let's increase it, the slope of the earnings is rising slightly. It is still not at the kind of slopes that we saw in 2009, 10, 11. But the liquidity is there, and instead of coming and testing the 16 multiplier or the 15 multiplier, the market, because of all the liquidity, will probably test the 17 multiplier, which is around the 2130 level, which was these previous highs. This is where the market is again. You can see that we are exactly where we were on the multipliers on the blue lines when the market was making these highs. So what do we have? We have a situation that for the foreseeable future we actually stuck in a 2020 2030 to 2120 2130 range. This is what the fundamentals are telling us. We can see it even better the closer we and that is all that can be said for this market. If you invest here at 2100, you have 1%, 1.5% on the upside. You are subject to very violent moves down on negative surprises. That is the problem. Therefore, you do not want to position in this kind of market for the long term, but you want to trade it short term, just like this area here. You have a huge compression area which lasted months, where the market traded 2050, 2120, 2130. We think we're going to see this again for the next 2 or 3 months. So there is not much that we can do. We can trade the market that we have. So from our point of view, we are a bit like doctors here, taking the Hippocratic Oath, which is saying, first of all, do no harm. You will do yourself harm if you buy the market at the times 17 multiplier and just decide to hold it. You will inevitably get a nasty surprise on a piece of data or a piece of news, and the market will come off 30, 40, 50 points and spit you out of the bottom. So don't do it. Don't position yourself. This is what we're going to do. We're just going to trade it, and we are going to trade it for less. So whereby we would be looking to make 30, 40, 50, 60, 70, 100 points a few weeks ago, we have now recognized that the market has changed. And if you make 10 points, you're doing very well. You will probably only make 5 points, but you have to do it often, and you have to do it probably in larger size and with tighter stops. And this is what we intend doing in the weeks and months ahead, because we think we have probably at least 6 months of this kind of configuration going forward. These blue lines will rise only very, very slowly. It'll take quarters for them to get to even 2200. Probably the end of the year. So you're talking about a market which might be stuck in a 2020, 2130, slightly rising only in the third or fourth quarter going up towards 2200. This is going to be a very tedious market with periods of intense downward activity. Just like it was here. Nothing has changed. May God help us. We will try to do our best for ourselves and to guide you through this kind of market, but we recognize that this is not going to be repeated, and we think that down to time 16 will not be repeated. So we are stuck in a 50 to 70 point range for the next foreseeable future. Thank you.